choosing the right partner. You start to understand, what are the types of capital partners are going to be good based on where I'm at today. You've done the work on preparing yourself for a capital raise, and hopefully you've got options to choose from, right? So how do you pick who is going to be the best partner for you to help you grow your business? And I like to think of this really around some decision criteria that really have three components. So the first one is ease of use and execution. So this comes down to how easy is it going to be for me to get this money, and how confident do I feel that this capital provider is actually going to close, right? Actually be able to come to the closing table with the money that I need. The second thing here is terms, right? So terms are everything from how much is this cost? How much is this capital going to cost from an interest rate, from an origination fee? Terms is also things like leverage. How much money am I getting, right, as part of this? How much do I have to bring? As well as all the other kind of ins and outs of the terms, the personal guarantees, and everything else that go into the legal documents. And then the third thing here that I think should go into this decision criteria are scalability and service. How equipped is this capital partner really to help me grow my business and serve me and help me to grow that business today, but also into the future? So the reality is, if you're just getting started, you probably can't optimize for all three of these things. You may only be able to optimize for one, right? Like ease of use and execution, maybe the only thing you care about when you're getting started. But as you build more experience and have more credibility, you may not be able to optimize for all three, but you certainly want to try to optimize for at least two of them. And again, the thinking here is what's most important for me today, but what's also likely going to be most important for me in 12 to 24 months from now, and try to start to align yourselves with capital partners that can support you today, but also hopefully will be able to support you as your business grows. So let's talk about ease of execution a little bit. The first question you have to answer is this type of capital even available to me with where I'm at? Right? So again, if you're just getting started and you're reaching out to a lot of those institutional capital partners, that may be a waste of time, because most of them, again, are going to require some level of experience. It may make more sense to figure out, how you get either friends and family or start to network with the local private money investors. The second thing then you should start to understand from an ease and execution perspective is what's involved in the underwriting process. Talk to the lender and understand, like, what are the steps? What information do you need from me? When do you need it from? How long does this typically take? Things like that to really start to understand, man, is this going to be very painful to kind of, check all the boxes that they're going to require, or does it seem rather straightforward? The other thing that you're going to want to figure out from an ease of use and execution perspective is, are there any third-party dependencies, right? So one of the biggest dependencies, particularly if you're working with larger institutional investors or banks, is most of them require some type of third-party appraisal, third-party valuation. Third-party valuations and appraisals can take 30 to 45 days in today's market. So if you've got a 2-week closing and the closing is dependent upon getting a third-party appraisal, that's going to make it very difficult for you to meet that closing date, right? So starting to understand what are all the dependencies that are going to be required to be checked before we can actually get the capital. Pay attention to how responsive and how quickly your lender's responding to you. Are they getting back to you in the same day? Are they getting back to you a week later when you're applying for a loan or when you're working through the due diligence process? And that's going to be pretty indicative in terms of how easy or hard they're going to be to work with as the relationship gets going, right? So pay attention to little things as you're building these relationships to really get a sense of, what is the service level that I can expect from this particular partner. The other thing that's important to understand is where does their money come from, right? If you're dealing with friends and family or private money, it's likely that person's money. But as you get into the institutional side of things, there's a lot of different ways that lenders structure themselves. Some are direct money. It's the founders and some of their friends' money. Some goes all the way as far as like brokers. They've got no money. All they're doing is they're going out and finding other lenders and putting people together. You want to have a pretty good understanding of where their money's coming from, because that's gonna tell you how much confidence you should have in that execution piece of it. Right? Am I dealing with the person that is actually controlling the purse strings? If so, there's a higher likelihood that they're going to be able to make the closing happen, in the time frame that they say. And then the last thing here is, do you have a dedicated point of contact? So this is, again, primarily for that institutional capital partner. Do you have someone you can go to? Are you primarily dealing with a website and a chat bot, right? Or do you have a contact you can get in touch with and work with to resolve anything that you're going to need to resolve as you work through a closing process? So that's the kind of the first leg of the triangle, if you will, right? So it's how easy is it, and the execution piece. The second leg that I think is important is terms, right? So terms to me really break down into two buckets. And the first one that we'll talk about is costs, right? So a lot of this industry is going to be focused on what's the interest rate and how many points do you have to pay, right? Or the origination fee. But there's other costs that also generally come along with these, particularly once you get into institutional capital. There may be legal fees, there may be doc prep fees, there may be appraisal fees, draw fees, extension fees, default interest. So make sure that you have a clear understanding of what is the fully loaded cost to borrow this capital or to structure this capital. If you're doing an equity deal, what are the profit splits going to be, right? And I've seen these go as far as 20% in favor of the operator and 80% in favor of the owner to 50-50, right? So there's a lot of room for negotiation on how you're splitting the profits and ultimately, who's responsible for what. But if you are doing an equity deal, model it out, right? How much is that going to cost me in terms of the profit share relative to if I structured it as a debt deal? The other thing that's important to understand from a terms perspective or a cost perspective, particularly on loans, is how is the interest calculated? How's my interest payment calculated? Is it calculated on the full loan amount, or is it only calculated on the amount that I've drawn? When you work with the institutional lenders, they're going to hold a certain amount of money back. And they're going to release that money as you make progress on the property and improvements to the property. Are you paying interest? Are you paying interest on those dollars that you don't yet have? Lenders do it both ways, right? So making sure you understand what balance is the basis for your interest calculation. The next thing, kind of within terms, is big is leverage, and there's a lot of talk around loan to value ratios and loan to cost ratios, and sometimes it can get very confusing even for me. So I like to keep this simple, right? So I think the first thing that you should care about is how much money do I get at closing? From a first distribution perspective, if I'm, let's say, buying the house for $100,000, am I getting $80,000 at closing, $90,000 at closing, $70,000 at closing? How much am I getting when I close the loan? The second thing you should care about is what's the total loan amount? Right, so if I'm buying the house for $100,000 and putting $50,000 in it for renovations, is my loan balance $150K? Is it $140? Is it $130? How much are they going to lend to me in total? Right, and you can take those two numbers, right? So what's my first distribution amount? What's my total loan amount? And you're going to be left with a balance, right? And that balance is generally going to go into one of two buckets. It's either going to go into prepaid interest or it's going to go into your construction holdback. Some lenders put none of it in the prepaid interest. Some lenders put 12 months into the prepaid interest, which can be okay, right? Depending on what you want to do, but understanding then how much do I get at closing? How much is my total loan amount? Where does the rest of it sit? And how do I get access to that? So when you're sitting down and you're looking at different options, whether it's multiple institutional lenders, some friends and family, some institutional lenders, private equity, right? Again, you're looking at your different options of how are you going to finance this project. Really what you want to boil it down to is your total cost of financing. So interest rate, sure that matters. Origination fees, sure that matter. But there's a lot of other things that go into that. And building out a way to simply look at, all right, from a dollars and cents perspective, how much do I walk away from the deal with once it's complete, assuming I hit my assumptions, and try to neutralize all of those other things so that you can get to, on a dollar for dollar basis, on an apples to apples basis, a good comparison on which capital structure, which lender is going to be best for you. And I should note, if you're working with a good lender, they can help you do this. Make sure that, again, you're looking at all of those things. The last leg of the triangle then is scalability and service, right? So one of the questions I like to ask people I'm doing business with is how much of this type of business, right, that you're trying to sell me are you doing today? If you're doing a commercial deal and you're talking to a lender that's primarily fix and flip with a little bit of commercial, may not be the best partner, or vice versa, right? So get a sense of how much of this are they doing, right? If it's fix and flip, or if it's new construction, or if it's light industrial, or if it's apartment buildings, whatever it is, you want to work with a lender that generally I think has some expertise around this and also have been doing it for some amount of time. The other thing I think you want to understand at some point as a relationship is developing is how much capital are they capable of allocating to you? Is it one deal? Is it 5 deals? Is it 50 deals? Is it 500 deals, right? So start to get a sense of like how far can this capital partner take me based on where I want to go and how I want to grow my business. The other thing you should start to get to know is, do they have a team, right, in place to match your growth? Is it a one-person shop, or is it a multi-100-person shop, right, that has servicing and underwriting and different things like that? Getting a sense of what the company behind the person that you're likely dealing with looks like is going to inform a little bit in terms of how far this company can take you and where your business is going. The other thing that's important is understanding how they handle construction draws. We talked about construction draws a decent amount. It's an an important part of this business and an important part for you to manage your cash flow. So get a good sense of, is it handled in-house? Are there third parties involved? Does someone come out and see the property? What do you need to show them, right, to get your construction draw? Start to get a sense of what's going to happen after we do business together. After we close the loan, how's it going to work? And along those lines, right, how do they service the loans, right? Are they in-house? Who do you make your payments to? Or is there a third-party servicer involved? So you can start to understand what's going to look like after we're already in business together. And then the last thing here is, what happens to the loan after it's originated? Does it stay with the company on that company's balance sheet? Does it get sold off to somebody else? Not that selling loans are bad, but again, it's something you just want to be aware of going into that relationship. Who's ultimately going to be the person that you're going to be dealing with as the project progresses? So again, decision criteria. 3 things that I think are most important: ease of use and execution. How difficult is it going to be to work with this person, get the capital, grow my business, and how confident am I in their ability to actually show up with the money? Terms, right? So this is cost and leverage and some other things that you're going to want to understand what you're signing up for. And then the third one is, how well can this company scale and service as my business grows? Again, with the idea being that you probably can't have all 3, right? There's probably 2, if you're more experienced that you want to optimize for, and 1 if you're just getting started. What's most important for you in the business plan that you have set out?